Okay, chapter 13. This chapter is looking at transactions related to stockholders' equity. Corporations' owners' equity is called stockholders' equity, and the way people become owners of a corporation is through the purchasing of stock. So, corporations issue stocks, and investors become shareholders by purchasing them. So, we're going to look at the accounting for stock transactions here. Bush Corporation has issued 2,000 shares of stock. We will prepare the entry for the issuance under the following assumptions. This first one, the stock had a par value of $5 per share and was issued for a total of 52,000. The stock was sold. The corporation received cash. Cash will be debited for 52,000. And the amount recorded into the stock account will be at the stock's par value. Only the par value is recorded into the common stock account when there is a par. 2,000 shares at $5 per share. Total par value of shares issued, $10,000. Any excess owners paid in exceeding the par value of the stock will be recorded in the paid in capital in excess of par, 42,000. In B, the stock had a stated value of $5 per share and was issued for a total of $52,000. For purposes of accounting, there's really no difference between the par value and stated value. They both really require us to record the same. So the journal entry is going to pretty much look exactly the same. We will debit cash for the amount of cash shareholders paid. We will credit common stock for the stated value of the stock, 10,000, and any excess paid into capital over and above the stated value, 52,000 minus 10,000. The excess of 42,000 is recorded into the paid in capital and excess account. In C, the stock had no par or stated value and was issued for a total of $52,000. For corporations that do not have a par or stated value, there is no need for a paid in capital and excess account when there is no par or stated value. That means that all of the cash paid for the shares, debiting cash, all 52,000 is credited into the common stock account. In D, the stock had a par value of $5 per share and was issued to attorneys for services during the incorporation. Those services are valued at $52,000. This is actually quite frequent. When corporations begin, they do not have the cash on hand to pay attorney fees or promotion expenses or any other types of an expense incurred to organize the corporation. So what ends up happening is the corporation, instead of having cash as the payment to those who are providing their services, they offer shares of stock. In other words, they're offering ownership in exchange for helping get the corporation up and running. So here, instead of the issuance of shares being for cash, the issuance of shares are to pay an expense. So we will debit the organization expense. The amount of the par value, $5 per share for 2,000 shares, is credited into the common stock account, and the excess paid in over and above the par is recorded into the paid in capital and excess account. So the excess of 42,000 will go in there. All right, in the last example, the stock had a par value of $5 per share. It was issued for land worth 52,000. Again, this is also somewhat common. When a corporation doesn't have the cash available or prefers not to pay the cash, they're purchasing a large asset. Sometimes they will just give shares of stock in exchange. So instead of increasing cash, the total value of the land is debited into the land account. The par value of the stock is recorded into the stock account, 2,000 shares at $5 per share. And any excess paid in over and above the par, the excess of $42,000 is recorded in the paid-in capital in excess of par value account. Okay, this next problem is going to have us continuing to work with the issuance of stock. And then we are going to prepare the stockholders' equity section of the balance sheet for the end of the year. On January 1st, ABC Company Incorporated, brand new corporation, authorized 100,000 shares of common stock and 10,000 shares of preferred stock. This means that over the life of the corporation, total shares of common stock authorized to be issued are 100,000, and authorized 10,000 shares of preferred stock to be issued over the life of the corporation. 2 weeks later, the company issued 10,000 shares of $1 par value common stock for $15 per share. So when they issued the stock, they sold the 10,000 shares for $15 per share, bringing in cash to the corporation of $150,000. The amount recorded in the common stock account will be the par value, 10,000 shares at $1 per share. 10,000 will go into the common stock account. The excess paid in over and above the par value, 150,000 minus 10,000, in excess of 140,000, goes into the paid-in capital in excess of par. ABC Company on June 15th issued 1,000 shares of $100 stated value, 9% preferred stock for $120 per share. Some of this information we don't need right now, but let's just talk about it since we're here. Par value will not only have a stated value or a par value, but it will also have what's called a stated dividend rate. And that's what this 9% is. And that stated dividend rate is the percentage of the par value, or how much of a dividend a preferred shareholder will receive in a year that the company pays a dividend. Okay, so that's what that 9% is. All right, so here they're not paying a dividend, they're just simply issuing the stock. So they issued 1,000 shares at $120 per share. Total cash received is $120,000. The par value of the stated value of the stock is $100. 1,000 times 100. The total par value, stated value, is 100,000. That's the amount that will be recorded in the preferred stock account. And the excess paid in over and above the par value will be recorded into the paid-in capital in excess of stated value. Okay. All right. Finally, the last stock transaction was on August 15th. The company purchased 1,000 of its own common shares for $12 per share. So what ended up happening is they issued a bunch to raise the cash to get the company up and running. Then in August, they decided to buy some of that ownership back off, and what they did was purchase shares off of the market. And when a company purchases its own shares off of the market, they're decreasing the amount of owner investment, and it's called treasury stock. They're repurchasing and holding that stock in treasury. So the very simple thing when it's purchased is to take the number of shares times how much they paid per share, and that is debited into a treasury stock account. And they paid $12,000 in cash, so cash is credited for $12,000. This treasury stock account is a equity account, and it is a decrease. It decreases the value of the paid-in capital. Because the more treasury stock that's purchased, the more the owner investment goes down, the more stockholders' equity goes down. So treasury stock has a debit balance because it offsets the other stock accounts. It decreases them because stock is repurchased back from shareholders. Okay. All right, let's take a look at how this company's stockholders' equity section would look on the balance sheet as of December 31st of 2008. What we're going to do is we're going to look at the amount of stock that had been issued and what the balances would be in these stock accounts. Okay, So we're going to ignore the assets. We're only looking at the stockholders' equity section. And it would look something like this. Okay. Preferred stock is typically reported first. It gets first of everything. It's paid dividends first. It's listed first in the balance sheet. So what we're seeing here is in the stockholders' equity section, in this partial balance sheet as of December 31st of 2008, remember, stockholders' equity consists of two things: the amount of investment, or the amount that investors have paid in capital, and the amount of earnings that the company has retained within the corporation. So first things first, within the paid in capital, we're going to list the capital stock, and the description just simply states what type of stock it is. This is 9% preferred stock. Okay, that comes straight out of this problem here. It has a $100 stated value, again, just given in the problem. It has been authorized to issue 10,000, I'm sorry, I jumped down. 10,000 shares are authorized. 1,000 shares have been issued. What do I mean by that? I mean that the company issued 1,000 shares back on June 15th, so that's the number that have actually been issued, and all 1,000 are still outstanding. That means that all of the issued shares are still held outside the corporation by investors. The total par value of the preferred stock is $100,000. That's the amount that was recorded in there. Then we also have common stock. The common stock has a $1 par value. 100,000 shares of the stock had been authorized. Okay, again, that was all detailed up here. 100,000 shares of common stock authorized with a $1 par value. Of those 10,000 shares that have been issued, we issued those here on January 15th. Of those 10,000 shares issued, only 9,000 are outstanding. Why are there only 9,000 outstanding? Well, recall on January 15th, we issued 10,000 shares. But then on August, we purchased 1,000 of our own common shares back off of the market. So even though we had issued 10,000, 9,000 are the number of shares outstanding. Okay. The total balance of the common stock account is $10,000. So that's the balance we're reporting here. Between the preferred stock and common stock, the total par value, stated value of all stock is $110,000. Then we add in the additional paid in capital. Let's see, preferred stock had $20,000 of paid in capital in excess, and common had $140,000 paid in capital in excess. Total paid in capital of $160,000. So between the capital stock par value and the excess, total paid in capital for this corporation as of 2008 is $270,000. We will then list out the retained earnings to get total paid in capital and retained earnings. And the retained earnings were just given in the problem here. Remember, retained earnings are the accumulation of profits less any dividends that were paid. So we now have total paid in capital and retained earnings of $295. But then we have to report how much of the paid in capital is now being held in treasury because of the treasury stock that was repurchased. And recall, we repurchased 12,000 of treasury stock, which decreases the amount of the owner investment, bringing total stockholders' equity down to $283. Okay, let's take a look at this problem. AI Corporation issued 100,000 shares of $20 par value, cumulative 6% preferred stock on January 1st. They They sold it for $2,200,000. Then in December, the company declared its first dividend of $500,000. We are going to prepare the journal entry to record the issuance of the preferred stock. So the total stock was sold for cash of $2.2 million. The par value of the stock is $20 per share times 100,000 shares, or $2 million total par. The difference between the issue price and the par is paid in capital in excess of $200,000. Okay. So now we need to look at the payment of the dividend. Okay. If the dividend is not cumulative, how much of the $500,000 dividend would be paid to common stockholders? Okay. What do I mean by cumulative? Not cumulative preferred stock means any unpaid dividends that belong to the preferred shareholders in prior years is not kept track of. So if a company does not pay a dividend in a particular year, we do not have to keep track of unpaid dividends and pay them to shareholders in the future. Because this stock is not cumulative, we're not worried about any unpaid dividends from the past. So we only need to focus on the current year's dividend of $500,000. When a dividend is declared by the board of directors, we always pay the preferred shareholders what they are owed first. Okay. To figure out how much the preferred shareholders are supposed to get, we will take the stated dividend rate. This stock has a 6% preferred stock dividend rate, which means shareholders of preferred stock will receive 6% of the par value of the stock in dividends. So we have 100,000 shares of $20 par value stock issued. We have total par value of stock issued of $2 million. Multiply that by the stated dividend rate. The amount of the dividend that will go to the preferred shareholders is $120,000. That means that of the $500,000 in dividends being paid by the company, $120,000 goes to preferred. The remainder, $380,000, will be distributed and paid to the common stockholders. So here, if the preferred stock is cumulative, how much of the $500,000 would be paid to common stockholders? Okay. Total dividend is $500,000. Based on the stated dividend rate, preferred shareholders are supposed to receive $120,000 per year. This company began operations in 2009, and in 2011, the first dividend was declared. That means 3 full years of operations have passed before the first dividend is paid. The cumulative stock, preferred stock, means they should have been paid $120,000 each year, and they hadn't been paid in those first 2 years. So they're not only owed the current year's $120,000, but they are also owed the dividend from the first 2 years of the company's operations. So $120,000 times 3 means of the $500,000 in dividends being paid, $360,000 will go to the preferred shareholders, and the remaining $140,000 will go to the common stock shareholders. Okay, this exercise will have us practicing preparing a stockholders' equity section again. So we did this a few minutes ago. Let's work through another one. Okay, these stockholders' equity accounts are currently arranged alphabetically from the ledger of this corporation as of December 31st of 2010. So here are the balances. We're going to prepare the stockholders' equity section in the proper order and form. First things first, in the stockholders' equity, the paid-in capital is first. Within paid-in capital, we have capital stock. The preferred stock is first. So here we have 8%, $100 par value, non-cumulative preferred stock. 8%, $100 par value, non-cumulative. How do I know that 5,000 shares have been issued? Looking at this, if the balance in the account is $500,000 and we know the amount that we record into the stock account is at the par, if I divide the total dollar amount by the per share par value of 100, I know that 5,000 shares must have been issued. So I know 5,000 shares are issued, totaling $500,000. Then I have common stock, $5 stated value with a balance of 1.9 million. Here is common stock with a no par but a $5 stated value. How do I know 380,000 shares have been issued? By taking the total balance in the common stock account and dividing by the stated value. 380,000 shares must have been issued. However, when I look down here, I see that in Treasury, we hold 10,000 shares of the common stock there. That means of the 380,000 issued, only 370,000 shares are still outstanding. Total par value of all of those, 1.9 million. Okay. Notice that once common stock is issued, it is always issued, even if it is purchased back. And that's why we're showing only 370,000 outstanding, but the full 380,000 issued. Okay. All right, now that we have our stock par values, then we list the paid-in capital in excess of both. Additional paid-in capital, 280 and 900. The total par plus the paid-in capital, or the additional paid-in capital, gives us total paid-in capital of 3.58 million. We are then going to add in the retained earnings as the other part of stockholders' equity. So retained earnings given in the problem of 1,234,000. Paid-in capital and retained earnings added together give us 4.814 million. Then we subtract out the amount of shares that have been repurchased. Treasury stock has a balance of 120,000, leaving us with ending total stockholders' equity of 4,694,000. Okay, last problem here. And let me pull up the other document. All right, this will make it a little bit easier for us to work through this together. All right, so the stockholders' equity accounts of Castle were with balances as of January 1st of 2017 were as follows. They had preferred and common stock with their excess accounts, retained earnings, and treasury stock. During 2017, the corporation had the following transactions, and we are going to journalize them. No dividends were declared during the year. February 1st, issued 25,000 shares of common stock for $120,000. If we multiply the 25,000 shares, well, we don't even have to multiply it out. They've already done it for us. The cash of 120,000 was received. We credit the common stock for the par value of the stock, or stated value, which is $1, and the excess paid in over the par value, stated value of 95,000 is recorded in the paid-in capital and excess account. Then on April 14th, we sold 6,000 shares of that treasury stock, common, for $33,000. So, easy part here is cash. We received cash of $33,000 when we resold some of those treasury shares of stock. We need to figure out what the cost was of that stock when it was purchased, because that's going to determine how much we decrease the treasury stock account by. When the treasury stock was purchased, a total of $50,000 was recorded in that account. That was for 10,000 shares. So if I divide the total dollar amount by the number of shares purchased, the per share treasury price that we bought them back was $5 per share. So if we had purchased them for $5 per share and recorded it in the treasury stock account at $5 per share. When we resold it, we are going to take it out of the treasury stock account at $5 per share. So if it's being resold, we will credit the treasury stock account $30,000. We sold it for $33,000. It had cost us $30,000. An additional $3,000 was paid into capital from the treasury stock over and above its original cost. So we have a paid in capital and excess account, a PIC account for treasury stock as well. Each type of stock has its own paid in capital account. Okay. All right, on September 3rd, issued 5,000 shares of common stock for a patent. The patent is valued at $35,000. So let me get this all into one page. Similar to issuing stock for land or issuing stock for organizational expenses, here we issued stock for a patent. So we debit the patent for the value of the patent, $35,000. Credit common stock for the par value of the stock that was issued, $5,000 at a $1 stated value. The excess paid in capital over the stated value of $30,000, 35 minus 5 or 30, is recorded into the paid in capital account. On November 10th, we purchased 1,000 shares of common stock for the treasury at a cost of $6,000. So now we are buying back some common stock off of the market. We record it as a debit into the treasury stock account for whatever price we pay for it. We bought it for $6,000, so we increase the treasury stock account with a debit. Remember, it has a debit balance because it kind of is an opposite effect on owner's equity. It decreases owner's equity, and we credit cash. Finally, we determined that net income for the year was $452,000. And delving into your memory banks from when we learned out how to close out accounts, income is closed out to income summary, and then income summary is closed out to retained earnings. So we are debiting income summary and crediting retained earnings. Okay, so we have those entries. Problem then walks us into recording the effect of those transactions into the general ledger. So we will need to take beginning balances in all of these accounts, enter them into, let me bring that back up again. It'll be a whole lot easier and then hurting your eyes going back and forth. So here's the beginning balance in preferred stock. Here's the beginning balance in common stock, and so on and so forth. So all these beginning balances are coming right out of the problem here. Then we are taking the debits and credits, ignoring non-equity accounts. So we're ignoring cash, and we are ignoring patents. That's an asset account. And we're only looking at the equity accounts. Okay, we're showing the impact of those transactions into the accounts by posting them. If you have any questions over posting, reach out, but that was something we covered way back a long time ago. So then we end up wanting to prepare the stockholders' equity section. This is prepared the same way we had prepared the other equity sections earlier, by listing the details of the stock, how many shares are authorized, how many shares are issued and outstanding for both types of shares of stock, listing the balances in the additional paid in capital accounts, all paid in capital, including treasury stock, balance in retained earnings, and then subtract out the amount of treasury stock to get to total stockholders' equity. Okay. All right, reach out if you have any help or if you need any help. I hope this explanation was useful.